Well, welcome. This is the February webinar for Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO. And the title this month is Art of the Deal, where we are going to dive into some of the biggest forces that we think are shaping the economy and markets this year. And we're only halfway through the month of February, but so much to talk about. Hi, Bob.
What a start.
Yeah.
Thankfully, this video will be much shorter than the Outlook in January. That was long because, there's a lot going on and we
Yeah.
wanted to articulate our way through it. This one will be much shorter. So let's get right into it.
Yeah. Let's get into it. And what we are going to do is follow the cadence that we have created, where first we are going to revisit the key themes that we think are important for 2025, but then we're going to talk about the markets, we're going to talk about the economy and policy, and then we're going to talk about this everything else bucket that I think will interest people.
Yeah, we'll have fun today. This will be a good one.
Okay. Let's start with some of the key themes that we mentioned in the January webinar for 2025. And we listed five of them. And we're, as you mentioned earlier this morning, we're already there.
Yeah, so again, our outlook just from less than a month ago, we talked about sort of in order of its importance through our lens. We talked about how the 10-year treasury is going to control the direction of the stock market. If the 10-year treasury gets too high, that'll act as a ceiling for the stock market. If it comes down a little bit, which it has, in the past couple of weeks, it will allow the market to run higher, and we will show you on a chart how perfect that is, or how the negative correlation is perfect. We thought that policy would certainly be in the news, whether it be monetary with the Fed, fiscal with Congress, and or with trade with a changing administration. That's certainly in the news, and we'll address that.
All there.
Oh yeah, changing regulation, the change in regulation from way too much to a lot less than that is positive for the capital markets and the economy. We're already hearing about that. Unemployment, our stealth item to focus on that not enough people are really paying attention to, which is the other Fed mandate. Inflation and employment are the two mandates. And then, a view on earnings and buybacks we think will be very powerful this year because we think the market will grow into its earnings growth rate. So we think the direction of the market will be very synced up with the direction of earnings growth this year, with buybacks providing assistance to that. So that's what we said last month, and we can check every box 30 days later, and we'll get into it, not in this order, but we're about to get into it right now.
Absolutely. That's great. Thank you. And so let's start with the markets and let's start with the 10-year bond, which you have coined the boss.
Yeah, look, I see the art in this that people don't see, but ultimately there is this in the red rectangle there, this perfect negative correlation right now. So you have a 10-year treasury that has risen from, let's call it mid threes a little over a year ago, maybe even less than a year ago, all the way up to just about 5% as of a month ago, or
And
very.
that's the purple.
Yeah, that is the purple line, right? And what you really see is for the past 3 months or so, the negative correlation, again, yield versus price of the S&P, is quite strong. And pretty much what that is saying is the higher the 10-year treasury goes, the more it directly negatively influences the stock market and really acts as a parent, as a barrier. You can't go here. Certainly a ceiling for the market. And as it cools off or goes away and cools down, the stock market then rises through it, right? So we believe that relationship will be very tight throughout the entire year. It'll get tighter the higher the 10-year treasury goes, which we think maybe the peak is behind us. But that is something that we're paying very close attention to because that will sort of influence the direction of the stock market. So this is just wanted to prove it to you, show it to you in this sort of non-correlated inverse chart. Makes a lot of sense through our lens.
Yeah, and if I can maybe add that if we are at that peak that you're indicating, that creates more opportunity for the bond performance going forward in the portfolios.
Absolutely.
And another indicator that is so important is looking at earnings and how they drive long-term growth.
Yeah, earnings have a huge influence on the direction of the stock market. If you measure over a very long period of time, 10 years or greater, and if we ever show you a chart over that period of time, the direction of earnings and the direction of the market are linked, right? In
Mm,
shorter snippets, you can see that it's disconnected, but if you measure in years, if earnings are up, the stock market is up. If earnings are down, the stock market is down. What you see here is us showing you sort of a breakdown of the S&P, the top 7 companies versus the remaining 493 companies of the S&P. The past couple of years, we've seen massive earnings growth, really focused in the top 7 companies,
yeah.
carrying the weight of the entire market. And now the out years, this year, the full year, its expectations for earnings, or the market's expectation for earnings growth. And next year, you see the rest of the market catch up. So,
Yes.
what does that mean to us? Well, it means that we're passionate about what we've been saying for the past couple of quarters, that there's opportunity outside of just the top of the S&P 500 and outside of just the S&P 500. There's earnings growth and opportunity elsewhere, small caps, mid caps, dividend payers, so on and so forth. So we'll get into that. But this is very good. This adds breadth and depth to the market, which is a very good thing for investors.
Yeah, and as a reminder, the last 2 years of S&P return, which have been fantastic, were driven by the Magnificent Seven. And one of the things we talked about in the January webinar is we were talking about areas outside of that that we would see opportunity. And we're starting to see a rotation. I guess the question is whether it's sustainable.
Yeah, the rotation started the summer of last year. So that's where small caps started outperforming large caps. You started to see a bounce back of some of the dividend plays, the value plays in the market. And other asset classes as well. This is a very short snippet, but year to date, so this is since January 1st, we have, let's go bottom up. So the bottom performer is NVIDIA, right? So we'll take the top 3 companies of the S&P 500. NVIDIA has pulled back about 11.5%. Again, a lot of that had to do with the Chinese AI thing, trade talks, probably the fact that they have run up so far. The machines were quick to take some profits, if that makes
Mhm.
sense. So they're down 11.5% year to date. Microsoft down 2%. Apple is down 7% year to date. So the 3 largest companies in the United States are all negative. They're down so far this year. Doesn't mean they're going to end up that way, but there's opportunity elsewhere because when you look at, let's just call it other asset classes, other really good asset classes like convertible bonds, they're up 3% so far this year, which means they're outperforming Nvidia by 14% this year. High
Yeah.
yield bonds are up 1.5%. Small cap is up 2.5%, and the S&P glued together is up 2.6. So there's opportunity everywhere, right?
Everywhere. Yeah.
It's no longer just the top handful of companies, and we just wanted to illustrate that to our clients and our listeners because you don't often get to see the granular comparisons. You just get these quick talking points on TV that provide no help.
Yeah, and I think for any clients that are listening, you may have seen some rebalancing in your portfolio starting last summer, going into it really actually we were making trades in end of the year going into January. So a lot of that is thematic to what we've been talking about. Let's transition. We always recommend to our clients not to get too emotional about short-term performance. However, there is an observation that we think is interesting for February.
Yeah, historically, there were good months and bad months in the market. There's some consistency to it. You got to measure over a long period of time. But the known weak months in the market throughout the year are August, September, sometimes October. Those are the well-known ones. But there's also February. June is right behind it as well. February is usually a reposition, rebalance, regroup month for the markets. It certainly is after a presidential election
Hmm.
or even a midterm election. So when you really isolate post-election years, whether they be midterm or presidential election, it's really a repricing of policy and people and sort of rebalancing out the what can, what will, what might quickly. And you really see that sort of play out in February. I believe that will continue to play out in February. Does it mean it's going to be a bad month? No. Does it mean it's going to be a lot of movement? Yes. Because I think, look, even right now, if we tell people, hey, the market's been actually doing well so far this year, it's just the top 3 or 4 companies haven't been doing well, but everything else has been. they're like, wow, shocked to hear this. I thought the market was down. It's not. It's actually doing very well. If it continues on this pace, the market will be up 50% by the end of the year. No, look, I hope that happens. It probably won't. But I think it's interesting when you talk to clients and they don't understand that, well, there's so much noise and so much news and so much emotion going on. The market has to be down. It's
Yeah.
not.
Yeah.
It's not. It's up.
Absolutely.
But just keep in mind, February usually is a little bit more volatile than many of the other months. Again, it is the rebalancing, repositioning, repricing of various things that are going on, mostly political post election. And then we get into the more meaningful months that tend to have a, let's call it a better track record, like March, April, May, June, July.
Yeah. It always feels emotional in the moment, but in reality, we've been here before. So
Yeah. You just got to zoom out, breathe, and measure less frequently.
absolutely. So part of the emotion going on right now is this discussion around tariffs. So let's switch to the economy and policy piece of this.
Yeah, so again, covering those bullets that we outlined, we'll talk about trade policy now. So, we title this Negotiating the Tariff Way. So, last week, it was announced that Mexico and Canada would have a 25% flat tax, I'm oversimplifying, effective Tuesday, the following Tuesday at, 12:01 a.m. And, I think many of us saw that as a bringing the other party to the table to negotiate sort of tactic. And
Mhm.
wow, did it work? Now, what had happened was Monday morning, the market started to price this in. Wow, it's real. They're actually doing this. And 90 minutes after, people started to see it on TV and look at the markets and turn into CNBC. You had the president of Mexico on TV saying, "I've talked to President Trump. We're pausing these tariffs for 30 days. We're going to work on a plan for the border. We're going to work on fentanyl solution. We're going to assign troops. We're going to have a task force." And then an hour later, Canada chimed in, and again, tariffs were delayed or postponed 30 days. They're going to put a strike force together. So again, we've been telling our clients the tariff thing is a negotiating tool. It is to revisit the rules and strategies we've had in place and to maybe reprice them where it is maybe a tinge more fair for us
Mhm.
going forward. And you could see how so far these tactics have been, at least with the first two countries, pretty effective quickly.
Yeah.
And I think that will continue to play out that way. So I wouldn't worry so much about it. I think when anyone hears, well, if we're going to have this trade war, this is going to last forever, and we're not going to have soybeans, or we're not going to have wheat, or we're not going to have this. Of course we are. It is literally to bring the parties to the table to renegotiate things that they didn't think they were going to renegotiate
Hmm.
and to end up potentially in a better place. I don't think we're going to end up in a worse place. That's, my opinion. It's just tough to watch the negotiation,
Yes, of
and it's
course.
tough to price in. It's tough to turn off the TV station, and it's tough to not apply some emotion to it.
Hmm.
But it is just public renegotiating of big deals. And
Yeah.
unfortunately, that's what government is doing.
Yeah, absolutely. That's great. It's fascinating to watch. And you mentioned in the kickoff of this webinar that, the Fed has a dual mandate, right? It's all about price stability and employment. So let's start with the employment piece of this.
Yeah, so we think the sleeper item that the Fed will react to, and the market will very likely react positively to, is the unemployment level. And that unemployment level will likely rise. It will almost surely come from the hiring freeze, layoff, firing, reduction in force efforts of the United States government, the biggest employer in the world. If you look last year, all these monthly and quarterly jobs numbers that come out, the government was just about 21% of all hiring last year. So I guess I could put it this way: if the government didn't hire anybody last year, we probably would have had a recession. We certainly would have had one back in 2022. Well, what happens when the government doesn't hire anybody? Well, I don't know how many net hires there will be in this country, if the government isn't hiring anyone because they have been the big bloated hirer of workers consistently for the past, let's call it 4 years or so.
Mhm.
There's a lot of expense, there's a lot of benefits, there's a lot of self-employment tax, retirement plan contributions, pension funds, so on and so forth. It's above and beyond just compensation. And then you hope that with the 20 plus million workers, that everyone is efficient and effective in doing their job and not working second jobs while they're working from home, coming into the office once a month. Look, at the end of the day, we all know there's tons of waste, and we all know there's tons of good people that work at the government. But I think when you have this restructuring, whether it be at a corporate level, big companies, small companies, or government level, there's going to be some babies thrown out with the bathwater, as they say, right? So it's just the process that, if you work for a public company or a for-profit company, this is what happens. And
Yes.
this is what's happening at the government level right now. There'll be a lot of emotion. There'll be a lot of, well, what happens if this and what if they don't? Yeah, but that happens all the time in business as well. So, look, I think the net output of all of this hiring freeze, severance packages, remove this division, so on and so forth, is going to lead to really fewer government employees and
Mhm.
a significant savings for the federal government. And I think that will also lead to, whoops, we got rid of too many people. We need to hire a few people back
Right.
or new people back to do the jobs. But I think it shakes out in a way where the Fed has to do something about it. Well, the next slide tells you what the Fed is thinking. So
Yes.
every quarter, the Fed comes out with their long-term outlook for various things, whether it be inflation or government growth, GDP growth. They also come out with their target for the unemployment rate. Again, one of their mandates. Well, their target for the end of 2024 was 4.2, and coming out of the summer of 2024, it was a little higher than that, settled just below it by the end of the year. Their goal for the end of 2025 is a 4.3% unemployment level. Same for 26, same for 27. Well, there's no margin of error here, right? You have very little wiggle room. It shows you on the right side of this chart, the 4.10% where we are now. Again, we're still waiting for new jobs data to come in. Certainly will be adjusted when it does. And the black dot is the Fed's year end target for next year, the year after, and the year after. I'm going to bet the over on this one, seeing that you already have, I believe it's 30,000-ish federal employees taking the buyout package.
Yeah.
So that's going to move the needle a little bit. Those numbers won't get posted probably for months.
Mhm.
Um, but if we were to measure live, I can tell you that unemployment level is a little bit higher. So again, providing maybe too much data, but trying to articulate why we think the Fed is going to cut rates and why we think the reason for cuts is going to be unemployment is staring right at us right here.
Yeah, and in fact, we talked a little bit about how we think that the Fed may actually have to cut rates more than they are telling us they believe they will this year,
Yeah,
right?
so the Federal Reserve in September outlined, their view for 2025. That view was we'll cut four times. My view is it's going to be a quarterly cut.
Hmm.
It allows them to digest data quarterly versus being expected to make a decision at every single meeting throughout the year.
Correct.
In a quarter, you get a better short-term trend of the data, which way it's moving, and you also get to pull other indicators in
Yes,
versus meeting over meeting, it's just too short term.
exactly.
So I believe that they will cut quarterly, calendar quarter, which means we're in February. So they meet again in March, which means then
Right,
they might cut in March. And I think they actually will, even though they're not saying that because their language changed in December,
right.
trying to provide slack, some room for themselves. They said, hey, maybe two cuts. I'm going to go with maybe four. And if they don't do it in March, I think they will have to do a little bit more towards the second half of the year. Again,
Right.
primarily through the lens of higher unemployment.
Yeah, and yes, unemployment, but let's take that concept one step further and let's talk about the other mandate, which is inflation.
Well, here's the other one, right? If you talk to anybody, everyone has sort of changed their tune, saying inflation is going to remain maybe elevated for some time, and we disagree. Um, so I think everyone is forgetting that shelter housing is a 17-month stale, massive data point in inflation. And outside of the Northeast, there are many homes and condos and apartments for sale, and rents have come down, again, outside of the Northeast, all throughout the country.
Mhm.
So, inventory went from no inventory 6 months ago to a lot of inventory outside of the Northeast. Why? Well, interest rates are very high. A lot of the cash buyers have stopped paying cash, and people are a little bit more patient now, and rates are still high. So, what you'll very likely see is prices start to come down. You're already starting to see that in certain parts of the country. So, what's going to happen here is that weaker, softer, delayed inflation shelter number is going to impact inflation. And we think it will start impacting inflation next month and for the next 3 months after that, because the numbers that are going to roll out of the inflation number are hot ones. And
Meaning the monthly number,
yep, the
right?
monthly numbers, monthly for the next 4 months, there are
Correct.
hotter numbers that are going to roll off as the new numbers roll on. And we think those new numbers that roll on monthly will be cooler than what's rolling off. And what does that mean? That means the overarching inflation number may trend lower.
Right. And by the way, we have been observing this for the last number of years, and we have seen this already go into, already occur.
Yeah, we have seen a countless amount of people forget this,
Yeah. That was a
right?
great reminder. Yeah.
And we've been pretty accurate with our view of inflation, and we think that will continue. Now, look, can a trade deal or a pending trade item spark one of the items buried in the inflation data? Sure,
Mhm.
but we think that all works its way out, over the 6 month or 12-month period of time.
Yeah, absolutely. And one last point on inflation, you mentioned shelter.
Yeah, so here is inflation looking back 6 or 7 years or so, using the way the government calculates inflation, but with the stale data that they use. And then there's another version that's using the same weights, the same categories, but if we were to measure usually using live data, what
Hmm.
that would look like. What that looked like was inflation actually reached a much higher level if you measured live, and inflation today is at a much lower level if you measure live.
Yeah.
So these trends and this indicator here has been wildly accurate. We're going to continue to use it because this just shows if you use shelter live and all the other indicators live, you actually have an inflation number that's in the ones right now.
Right.
Um, we should also mention that very quietly at Jerome Powell's press conference, the Fed press conference, one of the moles that the Fed uses to plant questions when they want to change tune or change direction with their language asked a question, threw a softball out there for Jerome Powell to answer, and sort of asked about inflation and housing and all this stuff. And Jerome Powell's answer was interesting. He said, if you look at the effect of high rates on interest sensitive spending, for example, housing, he's also referring to big ticket items like cars. And if you look at the achievement of our goal variables, lower inflation, we're seeing the economy move towards 2% inflation.
Hmm.
Now, when you get the decoder out for the Fed, which we have, of course, it means that the Fed is really not so worried about inflation because beneath the surface, they see that the trend is lower.
Yeah,
That makes sense?
absolutely.
Yes. So these are the things you really have to pay attention to if you want to get this stuff right. And if you get this stuff right, then it finds its way into proper portfolio management. So sorry, we're nerding out here, but we just want to show you our findings, and this is one of them.
Yeah, absolutely. And one last point in regards to the economy and policy is regulation and some of the changes there.
Yeah. So under the policy front, we're going from way too much regulation to potentially no regulation. No, I'm kidding. But certainly significantly less. And we just threw a bunch of stuff on this chart just to show you that there's a 10-to-1 deregulation initiative. If you're going to come up with a new rule or a new reg, you have to identify 10 others that need to be loosened, removed, and there has to be no net expense outlay, no positive net expense outlay. So it can't cost anything.
Yeah.
They'll only come to the table if you're willing to get rid of 10,
Hmm.
and it can't cost a dime.
Sounds
So
easy.
that's one. Number two is the old financial Basel III bank regulations coming out of the '07, '08 financial crisis, some of those regulations on banks are still as restrictive as they were in '08, of course, for for good reason, but there are some negatives to it where banks aren't able to deploy capital the way they used to. We need banks to deploy capital if we want the economy to grow. We want people to get access to capital. So, they're looking at changing some of the capital requirement rules. And then the FTC, when it comes to mergers and acquisitions, we had the most restrictive head of the FTC in history now resign or go away with the prior administration, and now we have a new regime that's coming in. So we expect to see a massive amount of mergers and acquisitions, which are good for, generally speaking, the economy. Generally speaking, very good for the capital markets. So it's certainly a more pro-business, less red tape environment. We think we'll continue to see that play out for quite some time.
Yeah. So some items to keep an eye on. And let's transition to the last part of the webinar, which is the everything else. And there's two items we want to address. The first we'll spend a little bit more time on, but this whole conversation around DeepSeek.
Yeah, we'll fly through this. So DeepSeek, which is this Chinese artificial intelligence platform, was released to the public a week ago, and it sent parts of the stock market down. Again, the technicians overreact, the computers that overreact to this stuff. But is it anything? Is it good? Is it life changing? Well, it's something. What is it? Well, it is an AI platform that they are claiming, the Chinese are claiming, was created in a very short amount of time by not spending a lot of money,
Mhm.
and it's powered by the inferior NVIDIA chips that they have access to. Remember, China doesn't, or they're not supposed to have access to the super chips that power our stuff.
Mhm.
And everything that they said is false. So it's actually, they did spend a lot of time on it. They have spent a fortune on it, and it is powered by the strong chips. They got those chips from Singapore,
Mhm.
not directly from NVIDIA, of course, that would be illegal. So, you spend a week digging deep into DeepSeek, and you find out that it's a counterfeit. I just call it counterfeit because it comes from China version of AI that is also not free to tell the truth. So when you ask it things like, is Taiwan a country? It will say, I don't know what you're talking about, or I can't answer that. If you ask it who the leader of the free world is, and it says President Xi, and then you can actually see it delete the text and write, well, most refer to the leader of the free world as the president of the United States, but some don't. Um, you know, it is real artificial intelligence is supposed to be free of any of that stuff.
Yeah.
And it seems like it is just another version of China's, you know, counterfeit controlled stuff. But ultimately, is it something? Yes, it is still an artificial intelligence platform that unfortunately is being downloaded and used by Americans from the App Store. And we're already hearing stories that that's what they were trying to get at. They don't care about the output, they care about getting access to your data, your phone, everything that you have inside of your devices, your computer, so on and so forth. So I would tell you, if you're having fun using this Chinese AI, you might want to stop using it or change your name and move, because the Chinese, know all about you by now. Certainly at my firm, I have restricted people from using it, and we are just asking people to use it for us, and we are fine with that.
Mhm.
The next slide, when we talk about AI, look, why is China doing this? Well, they've been missing out on all the fun
Yeah.
because the US is the leader in artificial intelligence, which is, another form of innovative technology that, will be quite beneficial in the future. Certainly is starting to be beneficial now. There's a lot of money being spent on it
Yeah.
by Microsoft, Amazon, Oracle, Google, Meta, sort of the current leaders of AI. They've been spending money on this and working on these platforms for a long time with some of the best people in the world, with some of the smartest people in the world, allocating massive dollars consistently over time. So, China had to do something to say, "Hey, we're here. We're working on something too." I get it, but it is not what people were saying it was day one. I can tell you that much.
Yes. They have a lot of catching up to do, and I think this is a great example of how markets can overreact short term to information.
Yeah, and remember, at the end of the day, if the entire world is going to work on AI, we need more chips, we need more data storage, we need more infrastructure, we need more energy, we need more power.
Right.
And it was those places that sold off, those sectors that sold off when China released their AI.
Yeah.
Again, a bit of an overreaction.
And last point on DeepSeek. I don't know if you found this or Kyle, but man, you guys did your research on this.
Yeah, there was a good piece that we read. We're hijacking this from some of the research that JP Morgan put out off of some of the research that someone else put out. But it is, you get a giggle out of it. It's a little scary. So ultimately, what is this deep seek? So they were tinkering around with it, asking it questions like, tell us about Volkswagen car sales in China, and they were comparing the answers between all of the AI platforms, right? And what it was picking up on, or what the people researching this were picking up on, was the answers were very similar to one platform, the most popular platform in America, which is ChatGPT. The Chinese AI, DeepSeek, its answers were eerily similar, right? So it's like, wait a second here. So then they took it a step further and they asked the programs to program these impossible graphics functions. And then DeepSeek's answers were, let's just call it identical to ChatGPT's.
Amazing.
So then in December of last year, they asked DeepSeek, what model are you? Right? They asked the artificial intelligence item, machine, what are you? Who are you? And five times out of eight, it actually responded and said, I'm ChatGPT. So, I mean, look, it's something. Is
Wow.
is it a disruptor? I don't know that it's a. Yes, it's a disruptor in a sense where now we have this AI that is using our platform to help answer questions, but it also has government control and some propaganda in it. So it disrupts things because the trust of some of this stuff,
Hmm.
the trust level has to go down because of this. Certainly when it comes to DeepSeek. But let's not overreact to it in an investment way and start thinking that our artificial intelligence is inferior when, in fact, the Chinese artificial intelligence is piggybacking off of our AI engines.
Hmm.
That's a
Yeah.
lot to say, but it is wild. And for many of you, you probably haven't heard any of this stuff. Well, I probably just saved you a whole bunch of time.
Yeah.
Uh, so so
Man,
more to come on this because you all will probably hear more about it in the months ahead.
I think we will. And one last item that I also think is interesting, and it's not really at the forefront of the media, maybe just yet, is this whole conversation about a U.S. sovereign wealth fund.
Yeah, so there are over 100 sovereign wealth funds that exist. There are actually north of 20 that actually exist within the states
Hmm.
of this country. And really, what is it? Well, generally speaking, it's an excess reserve account. It's like an emergency savings account. Some view it as a long-term investing account. Saudi Arabia has an enormous sovereign wealth fund. What do they do with it? Well, they invest in commodities, they invest in the S&P 500, they
Hmm.
diversify their money into other parts of the world and other things, right? And if they have a rainy day and they need to tap into a pot of money, they can tap into this sovereign wealth fund. So is it a wise thing? Well, I don't know if it's wise or not, but it is a thing. And you look at, I believe Norway has the largest sovereign wealth fund. It is their pension fund, which is invested in everything. Hong Kong, the UK just announced that they are creating a sovereign wealth fund. So ultimately, it is investing in various things. It could be as vanilla as the S&P 500 or the foreign stock market indices. It could be as vanilla as buying U.S. bonds, treasury bonds, corporate bonds. You could buy anything really. Bitcoin. We joke because we put TikTok and Greenland and Canada and Bitcoin and oil and lithium and Salvadorian prisons and the Gaza Strip all in this sovereign wealth fund. We say that kind of jokingly, but this has been floated out there. Is it good or bad? I don't know. I think ultimately having a rainy day fund to tap into instead of having to go to the Fed and Treasury in an emergency to change policy for us to stimulate, the economy or to access huge swaths of capital. It's probably not the best thing all the time. Maybe it would be helpful to have some type of portfolio with, let's call it excess reserves. Yes, we do have some excess reserves. It was called the Treasury Guarantee Account, the TGA,
Hmm.
which does have some money in it, quite a bit. Could we do it? Sure. Do other countries do it? They do. Will it involve owning Gaza and Greenland and Canada or Bitcoin? Who knows?
Yeah.
Uh, but it does make sense to have a reserve fund. Now, the question might be, but we have $36 trillion of debt. We do. That doesn't mean we can't borrow money to set up a fund, because we do have this ability to sell our bonds to raise capital all the time and spend that money on things like Social Security, which is set to run out in 2033.
Yeah.
So I think if people are willing to, or countries are willing to invest money here, knowing that they are just giving us money so we can make payments, I believe they would be willing to buy our treasuries, knowing that we're setting up a reserve fund. So, it's a controversial thing to think about and talk about. The issue might be who's going to manage it. Well, if our government, who has created the $36 trillion of debt, ends up managing it, then we might want to rethink this whole strategy.
Hmm.
We certainly need a bipartisan professional in the industry who can make long-term decisions at the helm, or a good team of people that don't change with the incoming and outgoing administrations. Then, we should be open to it.
It'll be very controversial, but I think everyone agrees that something is needed, right? I mean, we learn in Financial Planning 101 that emergency savings are prudent.
Yeah.
So, yeah,
Yeah, look, at the end of the day, if you look at the biggest companies in the world, and the biggest unions in the world, right? They have pension funds.
right.
So, the California state pension system, what do you think they do?
Hmm.
They're invested in hedge funds, private equity, the S&P 500, anything, timber,
Yes.
commodities, Bitcoin, anything that they can find, they will invest in, and they will add a very small piece to diversify their portfolio, because they have to earn a return that is greater than the outflow of capital. So I think we should be willing to do the same thing at the national level. The controls, how you set it up, and what the asset classes are, we need to pay very close attention to.
Yeah, absolutely. So thank you for going through that. And I would just comment that, the landscape is never predictable. And we're certainly going to have our share of uncertainty going throughout the year. But what I hope that the listeners are gaining from this is that we continue to monitor and obsess maybe a little bit about the information that's out there. And it's important in terms of how we make these decisions, whether it's the investments or whether it's the financial planning, to be honest. So thank you, Bob, for going through all that. And again, as always, we will be back in March for another monthly webinar. But please know that if you have any questions, you can reach out to any of us here at Principal Wealth.
Absolutely. Yeah. And stay cool. Transitioning administrations, changing politics, changing initiatives, changing people. It's a recipe for more emotion. Zoom out, understand that change happens all the time. And look, ultimately, there are really two political parties. Those two parties are the parties that are happy when there's change and unhappy when there's change. It depends on who's coming in and out.
Yeah.
And that wheel keeps rotating. So for anyone that is, celebrating and happy because of the change in politics, there's another person who is not, another team of people who is not, and vice versa. So I think if we understand that, that provides an offset. So we should be emotionally neutral, and the show goes on and life goes on, and focus on the things that really matter to you. Don't spend too much time digging through the weeds of, the media online and articles. Go outside, have fun, enjoy your family, enjoy your life. You only have one. So that's my best advice for everybody.
Well said. Thank you again.
Great. See you next month.